Welcome to our fifth Longview Conversations with our regular quarterly podcast, where we get on people we think are interesting for financial market participants and people that want to really dig into detail. That's what we want to do on these podcasts, dig into detail in specific topics. As I said, this is our fifth one. We had a series over Christmas of what might break as the Fed tightens. Obviously, the old saying, the Fed tightens until something breaks, was something we were focusing on Christmas, at Christmas time. And of course, something has broken, as we know. On top of all the crypto stuff that's broken, we've had a banking system in the US that's broken. But we haven't actually had break what we talked about in the podcast at Christmas, which was to do with dollar lending into Asia, and also some of the Chinese accounting practices. So what we're doing today, China's come through very well so far. It's looking in great shape, or it's certainly looking like it's improving. And I'm really thrilled today that we can focus on China, and we've got Chen joining us to speak about that today. So Chen, welcome from Shanghai, I believe, is where you're sitting at the moment.
Hi, Chris. It's very nice to be on board and to talk about China. As China, I think everyone is welcoming China back. And I want to say that China is back.
China is back, and that's great. That's really good to hear. And China is back, and you're back, and we're going to get into that topic in detail as we go through. Let me just give people a bit of background on you and your CV, so they know where they're coming from. And correct me if I get this wrong, but you're the editorial director of the Economist Global Business Review, which is based in Shanghai. You're based in Shanghai. You were just saying you haven't been outside the country since, I think, 2019, not surprisingly, for all the reasons we know why. And then before that, you were head of editorial Asia Pacific for Eurofinance, and you were the editor of the CFO China. You've also worked for Business Week, Bloomberg News in Singapore, and Xinhua News Agency in Beijing, and you've got a host of degrees and all sorts of other things. Welcome. Anything I've missed? I believe you've studied in America and in China back in the day, so you've got a experience of living across both sides of the Pacific, if you like.
Yeah, I think Pacific is our home. So I studied in the States, especially in San Diego, where I got my degree on international relations and economics. And of course, posting in Hong Kong and Singapore give me a view that's outside China and looking at China from the outside. And I think the past 15 years really like a deep dive in China. And it's also, I think I'm a witness to China's phenomenal growth, and also a witness to the last 3 years of challenges that China faces. So we are in a kind of a transformative time, but still I think there's a lot we can discuss about China, because I think there are foreign views, Western views, and there are internal Chinese views. And that's the kind of bridge we are trying to create. Yeah.
That's fascinating. And I'm actually really looking forward to hearing the nuances and the subtleties and the different views from the different parts of the world. And I think you're the perfect man to speak to these things about, as you were saying, with having had seats and lived in all sorts of different places with those different kind of views. So just in terms of warming us up, I always like to ask about the local equity market. And if I think about the Shanghai Composite, it's up about 7 or 8% this year. It's made a bit of a major low in October last year. It's up about, I think, 13, 14% since then. It's not above its highs of 2020, 21, but it certainly looks like it's moving higher. Where do you think, if you had to have a guess, I think I'm right in saying you're not a stock market forecaster, you're more of a macro guy, but if you had to have a guess where it would be in 2 years' time, would you go flat, up 50%, or down 50%?
So it will be flat with a slight upward trend. So because if you look at the stock market, especially the A share, is not a good indicator of China's overall economic performance, right? It's being flat if you compare it to today versus 2015, but the Chinese economy has grown at least 30 to 40% in that period. So it's not a good one, but there are incremental improvements, like small improvements, just last week, the Chinese the authorities has introduced another round of reform. So you got companies don't need to go through the rigorous application process. You need to register with your broker, and you are entitled to get yourself listed. So I think there'll be more interesting small companies coming on board to both the main board and the kind of a growth board. So things are improving, but still, I think it's still a market that's not as dominated as before, but still very much dominated by the so-called retail investors. So you still don't have very powerful, very experienced, very long-term, forward-looking institutional investors in the market. But I think the benefit of having more or enable more foreign capital to invest in Asia, I think that's also one of the major breakthroughs that we've seen, major reforms that we've seen in the past few months. We would hope that this would help introduce a bit more like stability, or even kind of a different views to the market, so that the market could be a bit more robust rather than a boom-bust cycle. But still, I think it's not a good indicator. And of course, in addition to looking at China market, mainland market, I think it's important to pay attention to the Hong Kong market, because despite of all the challenges in the past 2 years, I think Hong Kong is back. And the fact that there will be more US listed companies delisting from US and relisting in Hong Kong would make Hong Kong a bit more promising. And of course, I think there will be more. Hong Kong is also trying to introduce a bit more reform, especially in the area of crypto, blockchain, and other things, competing with Singapore. And of course, that's also would make Hong Kong a bit more interesting. But again, we are still not out of the woods yet. So these are the signals that you say it's pointing to a more positive area, but there are a lot of uncertainties down the road.
Interesting. And actually, it was interesting, quite a lot of interesting stuff in that, actually. But you make the point that the Shanghai comp doesn't really represent well the Chinese economy, and you're quite right, it hasn't done much in a few years. I don't think it's done anything in sort of 15 years in aggregate. Having said that, you could make the same comment about the FTSE 100 in the UK and a bunch of other sort of Western equity indices. So I'm not sure that really tells us much. And it's interesting what you say about these reforms to bring in more institutional money, because it's been well known as quite a retail market. I think was it 2015, 16 when it ran up on retail margin trading, and then there was a change in the margin trading rules and the market collapsed.
2015. Summer 2015.
Yeah, I remember that.
All the way up to over 6,000 in 2 months. And then, yeah.
Well, then Z and the policy changed on margin trading. They made it harder, I remember, and the bubble burst. But so it's not indicative. But you mentioned the idea of bringing in more. There's some reforms to bring in institutional money, because actually that owns a whole series of topics. In particular, the whole openness of the capital account, because it strikes me it's very difficult to get a very good handle on how open the capital account is. But it strikes me it's become less open in recent years. I think that's a fair point. And I know you've got your Shanghai Connect and so on to allow money in, but institutions a couple of years ago were quite frightened by some of the policies that came out of China. And that scared off a lot of money, I think, when we saw a lot of things. So how do you think that China is going to attract this overseas institutional money, number one? And number two, how's it going to engage in building more of an institutional investment management business within China? So if you could address those, that would be fascinating.
Yeah, so I'm not an expert on this. So in terms of encouraging more capital moving upward, I mean, from Hong Kong or from elsewhere to mainland, I believe there's a fairly recent new regulation enable foreign investors to invest in both the domestic stock market as well as the bonds market, because bonds market is also quite big. So it's kind of an encouraging sign to add a bit more liquidity in the market. And I think in the foreseeable future, meaning because the past couple of months is really very much about re-establishing credibility, right? Because in the past 2 years, the major challenge is not the turmoil of COVID. It's about lack of credibility. It's about lack of prediction in terms of where public policy with regards to financial market, public policies with regards to industrial policies tends to shift dramatically without any further notice, right? So I think that would change, because if you pay close attention to the Lianghui, the parliamentary meetings in March, the signal is very much about stability. Is very much about China is back to focus exclusively on economic growth. That China wants to rebuild credibility. China welcomes foreign investors to go to China. So all these are good signals, and I think the relaxation on foreign capital to invest in the Asia and the bonds market is a very important sign. But risk is always going to be there, right? We don't have a crystal ball, and the track record in the past is not a good indicator. So it would take another. I always say it would take another 2-3 years for people to believe in the credibility of public policy. But I think the fact that China needs more capital in terms of both greenfield investment as well as more investors paying attention to Chinese equity and bonds market, I think it's the need is definitely there, because we've been arguing, and I don't know whether how much the policymakers have heard us, but we've been arguing that despite all the rhetoric of decoupling, China needs to make concrete efforts to embrace globalization more rather than less. So I think in a way that's
very interesting. So your reading of the Chinese policy announcements is really, just to sort of clarify, that there did seem last year a sense that China was in the last couple of years pulling away a bit from that globalization theme and pulling away a bit from the West, and there was a bit of a divide coming into play. Your suggestion is that actually what these latest meetings are telling us is, we should believe exactly what we hear, that China wants to fully engage with the West. I don't want to get into geopolitics, but the sort of Russian thing's a bit of an irritant. And actually the real thrust is economic growth and driving China within the global economy, basically, and re-engaging more fully and setting a steady policy path, I think is what I'm hearing.
Yeah, in a way, this kind of globalization is very much different from the globalization we are familiar with, right? So I've already mentioned, needs more credibility, right? So we are saying it's trying to re-establish its credibility. Whether China can do that, only time will tell, right? So we're not saying that all these are credible, but we are saying that there is definitely an intention to re-establish credibility. 2, it's purely about economic ties. So we won't talk about geopolitics, but geopolitics would be definitely the major kind of a unpredictable factor that everyone investing in China have to factor in. But we don't have a crystal ball, we don't have access to the minds of the senior leaders, so you really don't know. But these are the unknown that you have to put it high on your radar. But purely from an economic perspective, China needs to go back to growth paths. So that's agreed upon. China needs to beef up confidence in future growth. That's agreed upon. China needs entrepreneurs to believe in future, to believe that investing in China and also investing in areas where China could benefit, like Southeast Asia, is where things should go. So I think that's
Yeah.
Otherwise you want to leave China. But if you look across globe, right? Where are the places where you still see signs of promising growth? China is still one of them, right? If you look at the scale, if you look at the sophistication in terms of supply chain, if you look at the kind of human capital China has. So I think despite the fact that, demographic wise, the overall population is shrinking, but on the flip side, if China could transform itself even slightly for its economic model, having 10 million college graduates a year, that's all the college graduates put together to combine for the rest of the world. So that gives China the largest talent pool that you could tap into. But how to do that? Whether the economy can be transformed, I think these are the big questions. So what we are arguing is that for the next 2 to 3 years, the policymakers in China should, and the indicators has shown that they will probably put more emphasis on driving growth and overseeing this kind of transformation. But still, this kind of transformation is going to be very different from previous 2 decades. So it will be still very much state heavy, right? So the state enterprises will be leading, and then it's always going to be like industry policy focus. So driving investment in innovation, especially in areas where technology, China doesn't have the latest technology, and US is putting the so-called choke points. So that's an area that that China was
let me just interrupt you and ask about that.
Finish one last point before.
Okay.
But still, I think the most important thing is that if you look at individual companies or the commercial, the retail sectors in China, so it's still promising. Like if you look at auto market in China, it's booming, and then there's a lot of new things. So if you are a microeconomist in China, you will always be excited about the next big interesting thing. If you're a macroeconomist in China, it's always going to be yin and yang. So it's going to be the risks are there, huge, and then there are opportunities down the road. Yeah,
that's really interesting because this, as you started that explanation, you talked about this kind of globalization, and that's kind of leads into one of the key questions I wanted to ask you, which is how do you think the Chinese economy works from a structural perspective? Because I often think, I mean, I don't want to put words in your mouth, you'll have your own words anyway, but I often think credit allocation is a big part of the Chinese economy, its economic model. And it reminds me a lot of Japan in the 1980s. And I always think I think that's quite a dangerous approach to policy, because it's deciding which industries to promote and which not, and subsidizing them effectively with cheap credit. And it certainly got Japan into a lot of trouble in the end. But maybe maybe I'm misunderstood. Maybe that's a mischaracterization. So you mentioned this kind of globalization. How would you say the Chinese economy really works? What's it like in the world? So I'm guessing by using that phrase, this kind of globalization, you don't think it's like the sort of typical Western economy, for example, or the American economy in many ways.
Yeah. So I think that if you look at the Chinese model, if you want one phrase to summarize, it's an efficiency-driven globalization, right? So that efficiency tells a lot of things. Japan is also used to be very efficient, right? Efficient could mean you get the scale, right? So China, you take the Chinese manufacturing sector as an example, right? Whenever China wants to get into a big sector, be it the power generation, the solar panel or wind turbines, or be it batteries for powering EVs, you see efficiency, right? So first step is we provide you same quality but with lower cost at a scale. So that's kind of efficiency the Chinese.
So, but when you say efficiency, that's really scale that brings economies of scale, I think is the point, is it not?
it's not only the scale. So the Chinese definitely the leaders in Chinese the leading Chinese manufacturers are really good at scale, but in achieving efficiency, they are also making very quick catch-ups on being more innovative, but not innovative in terms of providing breakthroughs, but micro innovations that would make them really a leader in a certain sector. So I think this model is something you have to really appreciate. And I think that the second, so if you look at the strong point of, we're trying to look at China not necessarily from investment-driven, export-driven, or consumer-driven, that kind of framework. We're looking at China to say, what are the kind of leaders, champions in China? And we're not talking about state-owned champions. We're talking about market champions. So these are the companies definitely benefit from state subsidies and industrial policy, but they are champions anyway, because they are competitive not only in China but globally. So I would say there are three kinds of champions. One is the efficiency-driven manufacturers who also are entering into an area of innovation. So they are innovators. So if there's no industrial policy in the United States with regards to bring manufacturing back to China, back to the States, or with regards to developing U.S. Local EV sector, you bet BYDs and others, there are at least going to be 2 or 3 manufacturers in China who are going to be Toyotas and Hondas of the EV age, period, right? But the challenge for them is that they face geopolitical tensions that Hondas and Toyotas wouldn't face. So that's one area. The other area is what we call it the application area in the digital economy, right? So the likes of Shane, the likes of TikTok are really the applications, right? China is a huge market where there seems to be, compared to US and EU, less emphasis on data privacy and data security, so more experiments in all this algorithm-driven what we call it attention economy. And these are they use the same tools, or at least the algorithm trained in the China market, and try to repackage it and apply it in elsewhere, and they are very successful. So these are the two. And the third thing, of course, you have to go back to the Chinese construction industry, right? China, the emphasis on building roads and bridges and railways definitely allow many of the companies, many state-owned, gaining the capability. Their export into the Belt and Road Initiative, they're building things in Africa and Southeast Asia. They could make things happen. Whether it's creating a debt trap, that's a different story. But I think the kind of a still efficiency driven, right? So you can tell they are very efficient in manufacturing. They are very efficient in construction. They are very efficient in terms of applying algorithm to gain eyeballs. And then I think the Chinese are literally transforming themselves. So they are moving away from efficiency. So efficiency is a foundation, and then they are moving to the next stage. So they are embracing more diversity. They are embracing more what we call that the innovation. So that's how I see the kind of a building period. So that makes you optimistic about China. And then it's their benefit.
But let's just dig into that, because I mean that's an important point, and there's no doubt that there's some brilliant businesses in China. I mean, the Western audience would appreciate that Warren Buffett, I think, is an investor in BYD, that electronic vehicle maker you mentioned, and that's, of course, for a Western investor, that's a big tick in the box if Warren's on the shareholder list. So there's no doubt there are some great businesses, and some of the tech businesses. TikTok, of course, is huge in the West, as you know, huge across the globe. But it still doesn't get away from the fact that there is credit allocation and subsidies. And that was the model in Japan in the late 1980s. And they built world champions, whether it was Sony or Hitachi or a number of them, that eventually failed because the credit allocation model doesn't work on the basis of price discovery. And the problem with credit allocation is you get subsidized industries that eventually become saturated and margins end up very thin. That was certainly the Japanese experience. And I mean, margins, I'm sure margins aren't thin at TikTok. I don't know. But I would imagine a lot of, I think certainly if you look across the economy, the profitability is not high. I mean, certainly you've got issues with state-owned enterprises, which are perhaps in some ways separate. But in other ways, they're linked. A number of the construction companies, I believe, are state-owned that you talked about. So how do you deal with that? Because that strikes me as a real challenge, that it's not just a question of being world champions and world leaders in certain industries, but it's a question of doing it in a profitable way with sustainable margins and a long-term sustainable business model.
Yeah, I think, in a way, if you look at, still, I want to go back to BYD and TikTok and the likes. So these companies are not very much China concentrated. They are already global, and we would argue that they are benefiting from the Chinese subsidies, but their main driver, or they could tap into the global financial market and get the financing. So in terms of credit allocation for these champions, they are not the champions kind of beef up mainly because they are the benefits of Chinese state aids. They are really have a robust business model that could attract capital. I agree with you. I think that's also pretty obvious, agree upon among economists in China, that the continued investment in infrastructure in China is leading to nowhere. So the allocation. So what we are trying to argue, especially at a time when the policymakers want to continue to provide stimulus to the economy, is that we should shy away from building more roads, building more bridges, building more railways, and building more high-speed railways, but rather focusing on how can you make mega policies like the Yangtze River Delta, the Pearl River Delta, the central China. There are a few city areas in central China. Make it more Western, or make it more like Japan, meaning that truly, if you look at the Yangtze River Delta, there are still many pockets of countryside. How can you make them all urbanized? And that could absorb, like, say, 200 to 300 million people. At this stage, we only have about 100 million people in this area, and then try to create more jobs and try to create more consumer-oriented and service-oriented jobs. So that's not done yet, but there's a lot of discussion. So I think the discussion is really about who would you imagine as your role model for the next phase of development. It's definitely not going to be Japan in the 80s, trying to build the Shinkansen all the way down to middle of nowhere. So that's not going to work, right? It's not going to work in China. It's not going to work in Japan. But still, I think if you compare not Shanghai to Tokyo, but Shanghai area, the Yangtze River Delta to a big Tokyo area, or the Pearl River Delta to the Osaka area, then you see there are gaps. Yeah, right. China is still not Japan yet. Even the Yangtze River Delta is not major the macro Tokyo yet. So there's room for catch up. There's room for building more rapid railways, extending metro networks, linking cities easier, making people's commute easier, building more clusters of innovation and incubation hubs. So I think that's an area that's already being discussed. But remember the difference, the key difference. So I think that's one thing we need to bear in mind. If you compare to China to the rest of the world, one key thing that makes China very different from the rest of the world is that the state plays a very important role, more than anything else, because the state owns all the land, right? So in a way, all these counties, all these little jurisdictions are competing with each other to attract investment, to have their own mini version of industrial policy, has their own mini version of urbanization goals, GDP growth ideas. It's still there, right? If you look at China today, after post-COVID, the ones who are most active are not the entrepreneurs, but local officials, They are traveling around. They are going to major cities. They are putting out all these trade shows to try to say, come to us, and we have all these ideas, and we have our own policy. We have incentives to do this. So that's what makes China different. So it's not purely credit allocation, whether there are waste or not. Definitely a lot of waste. You don't want to see county by county coming up their own solar panel industries or other things. But the fact that local governments are competing among each other to try to come up with a better ways to grow business make you think that there are some kind of an efficiency in terms of, at the end of the day, some kind of allocation of capital. And what we're trying to sum up, I think what we're trying to say is that China still has about 10 to 15 years of urbanization, but very much needed urbanization that could absorb a lot of migrant workers and could create huge sectors of service and retail-oriented sectors. So it's not there yet. So when we say investment, export, and retail are not as balanced as other countries, so how do you rebalance that? China cannot rely on export because the global economy is not as booming as before. Everyone knows, but that continued investment in infrastructure in the rest of China, not in mega cities, is not going to pay off. So if more people would focus on nudging policymakers to really invest in major, like in China, there are at least 4 major mega city areas. And if you see investment in that area, then in 10, 15 years, you will see another 3 Tokyo areas. And that's going to be very interesting. Yeah.
Yeah, that's intriguing in many ways, and in some senses, one can see how there's some real positives in there. But I would still go back to the idea that there are very few examples of countries where they've broken through the development ceiling. And obviously, in some ways, China's massively broken through the development ceiling. But across the economy as a whole, obviously, quite a lot still ruralized. Average incomes are still quite low in a global sense. And it's not clear from that perspective that has happened, that middle income trap. And I always feel there's a couple of real stumbling blocks for progress. And one of them is an over-indebted economy, which I think it's hard to argue China is not. The debt levels are extremely high. As we know, the banking system has grown enormously in 3 decades, which is the other side of all those debt levels. And debt to GDP in the private sector is way above what we see in Western economies, even though Western economies are very high. So that debt, that soaking in debt, is one real key issue, I think. And the other is when you've got very heavy state involvement, for the very simple reason that I would say as one who believes in capitalism, that you need proper price discovery and you need proper returns on investment. And when the state's involved, whether it's in the West or China, those returns don't tend to be there. And while you mentioned the idea that local governments are going around competing against each other, that's all well and good. But a much better mechanism for properly pricing projects is capital markets and capitalism, whereby it's not just 10, 20, or 30 councils competing, it's thousands and thousands and hundreds of thousands, and the market discovers. So I'd be interested in what you say about that, because the stories about China's indebtedness and its banking system have been rumbling for a while. So have the stories about the overbuild. And if there really is genuine overbuild, there's no return, and those things have got to be written off at some stage. Now, I used to think a few years ago you could have compared China to America in the late 1800s, in the sense that they would have huge booms and then huge busts to clean out the system, and then off they go with another boom, and the development continued like that. And actually, China, of course, hasn't really done that. There's an attempt to deleverage the economy that sort of meant that leverage has been flat for a few years since 2016. But there's no real deleveraging and there's no big bust. So what do you think about that? Because I think economies work better if you clean them out and you have proper bust phases. By the way, that applies to the West at the moment as well. But let's just stick with the China story.
Yeah, so I'm not saying we are justifying a Chinese model, right? What I'm trying to say is that Chinese model is built on fundamentally different principles, and the challenge for China is whether it's not built on free market capitalism. I think everyone, you've been in China long enough, is not built on free
Yep.
market capital. It's not also not built on Soviet style planning. So it's a different beast, right? It's a
Yep.
beast where, so if the debt to GDP level, the indebtedness of the private corporation, it happens in a free market economy, the system should already have collapsed, right? But it's in China, right? The banking sector is very much state-owned, and the policymakers have certain levers and the belief that they can fine-tuning things, and there's always going to be a belief. I think it's being believed by not only the policymakers but also by private entrepreneurs that you can grow out of your problem, right? So growth is paramount. And I think the last 3 years, due to COVID and many other things, has caused a lot of problems because you don't see the growth as compared to before. And you're saying that the policymakers could be meddling with your affairs rather than advocating for economic growth. So I think when we say confidence building or reestablishing credibility is to say whether the beast could come back to pro-growth model, whether it's efficient in terms of capital allocation, whether it has danger of financial collapse or a financial crisis due to a high debt to GDP ratio. I think we can argue, but it hasn't happened yet. But what we are arguing and what I think people in China, the economists in China are arguing is that going back to the pro-growth model is very important because then you get confidence. Then you understand what are needs in the market. Then you understand that allocating capital in mega cities is much better than elsewhere. And then I think interests can be aligned. And going back to, I think, the debt to GDP one, again, I think that since China has the world's largest government, and there are still room for the government to in terms of macro, the fiscal policy and a monetary policy to absorb the kind of a mini banking crisis. I don't think China just. If you look at the cycle in China, China is very different from the rest of the world. China doesn't have the kind of inflationary pressure that elsewhere would have. So I think there's still room for China to maneuver, but we are already very much close to the edge. I think that's everyone understands the danger, but the danger could be addressed by two measures. Either you come up with more structural reform, but I don't think anyone in China at this stage can agree upon what kind of structural reform you want to be. Definitely not a free market capitalism economy, because that's a situation. So I think the kind of a common denominator is that let's put the economy back to the growth path, right? And that would help us, give us more breathing room so that we can deal with problems that.
Fascinating. I mean, and obviously growth is always good, although the quality of the growth matters. But that's a wonderful segue into, let's talk about the current state of the economy, and let's paint the picture as you see it, which has a degree of positives, and then we'll test that thesis if you like, and I'll come back with a couple of questions. So how do you see the Chinese economy at the moment from a cyclical perspective?
I think we argued even end of last year that Chinese economy need to be normal before it rebounds. So I think in the past, we just came out of woods for 3 months, right? So very recent, because if you look at early January in China, it's a huge COVID wave. And it's really after Chinese New Year that everyone is back to normal. So back to normal is number one. Number two, you've seen incremental rebounds. So February numbers better than January. March is slightly better than February, but I think compared to our forecast, compared to a lot of people's average expectation, the rebound is not as exciting
Yeah.
as you would expect. Yeah.
Yeah.
So
We had that disappointing manufacturing PMI data point the other day, for example.
yeah. So it points to structural problems. It points to the fact that what we are saying is that 3 years of COVID lockdowns have created problems that maybe we haven't seen, right? Because how many people have become kind of a invisible unemployed in the 3 years? How many have lost their jobs? How many doesn't have steady incomes? How many wanted to, because of the COVID lockdown, they want to save more rather than spend? So I think these are the questions that we don't have answers, but we've already seen that the fact that the rebound is not as exciting tells you a lot of things that you need to pay attention. I think
well, that's
that's
a great point. So is that telling you more about the lack of stimulus, that it's not aggressive enough, or is it telling you that if you look at household bank accounts, deposits in banks are up about, I think, 20% of GDP in 3 or 4 years. So there's a lot of cash in bank accounts, and we know in the West that when you unlock, people tend to go out and spend money. They want to get going and catch up on going out for dinner and all that stuff. So is it about the lack of stimulus? It's not punchy enough, or is it about people are just more cautious about spending that cash than we saw in the West, or is it something else? As you mentioned, the structural issues that maybe languish.
It's more of a latter than the former. And of course, we cannot just say how much savings have increased, but we also have to pay attention that if you look at different what we call different classes, right? The well-off, the super rich, I think we would even argue that they benefit from, or their savings and their income, their cash flow hasn't been impacted at all. It's really about the grassroots. I don't see, we don't have exact numbers, but I don't think they have saved more than before, right? And then they are very cautious to spend. So I would rather really looking at pay attention to the employment data, even though we don't have very clear, very trustworthy employment data, but that's an area that we really need to pay attention to, because employment means that if the economy is creating more jobs, means that the entrepreneurs are really trying to grow their own business. There are more faith in the future, and then that would translate into a more robust economies down the road. But I think at this stage, employment, at least in terms of employment for white collar workers and employment for college graduates, you don't see meaningful improvements, and that's worrisome. But again, it goes back. I don't think 3 months is long enough. So we need 2 to 3 quarters, because it's really about confidence building. Because if you talk to private entrepreneurs, unless you are in a sector like if you are in AI, if you are in AIGC, if you used, or last year, if you are in the area of metaverse, where there are going to be investors knocking on your doors. Other than that, it's still, I think many of these entrepreneurs, especially in terms of in the service sector, in the consumer oriented sector, their attitude is still wait and see. We want to make sure that the overall policy are stable for at least 6 months, 9 months. And we want to see that, after a few months, when, people are not less concerned about major shifts in public policies, then I think the willingness to spend money will be there. And I think summer is going to be a big, very important time for us to pay attention, because if you do see Chinese tourists coming out to the rest of the world, if you look at, so I think one important point is that in 2019, I think there are how many? There are 300 million Chinese tourists coming out of China, right? So if you let's say that the high season would be in the summer and in autumn, October, long holidays, that would be half. So how many Chinese would be going out this time, right? That would tell you a lot of things. And then, of course, if you look at the kids, right? If you do see parents taking their kids out to US, to Europe, to Southeast Asia, to Japan, then it tells you a lot of things. So I think at this stage, we are still not certain yet. But if you look at international flights, Chinese own airline industries are bringing more flights back. So it's still encouraging. So
so the trend's correct.
What I'm trying to say is that it's really hesitant on both consumer and entrepreneur side. And they are hesitant because they have the scars. We have to talk about the scar effect. So I think you cannot simply compare 3 years in China versus 3 years in the West. The 3 years in the West, the Western countries have come up with a policy of consumer first, stabilizing job market first, providing people incentives so that people could maintain their spending and even get more allowances. In China, it's really about let's keep everything in order until we couldn't, right? And then what's the expense? We've seen now I think the cost has gradually revealed itself. The cost is that there are many small businesses who have collapsed. There are millions of people who have lost their jobs. But these data haven't been registered, right, in the official statistics. Now I think it's time for us to say, okay, the damage is worse than we would expect, but we still think the economy is resilient as long as policy initiatives have become stable, credibility in the public policy and confidence among consumers and entrepreneurs could be improved, then I think people are still excited, right? So that's the thing. If you talk to any people today versus in Shanghai today versus 6 months ago, I think you see a sea change in the attitude, and I think that. I'm not saying that we are expecting magic to happen, but if you look at China, if you look at the Chinese economy in the past 3 decades, what you need are 3 things to drive economic growth. A, you need to have a accommodating public policy, right? A pro-growth public policy. B, you still need to have people to believe that future will be better than today, right? And the third thing, of course, is that if you see certain public policies that's not interfering with people's life and people's business, but at least a kind of a bit of hands off, and that'll be great. So we're not saying China is going to repeat what China could do in the 2010s or early 2000s, but still I think there are certain elements there.
Interesting. So in a way, what you're suggesting is that some structural problems from different policy approach during the COVID times is partly what's causing these challenges. And if I understand you correctly, of course, and it's well known that China's policy support during COVID in terms of economic policy support wasn't nearly as dramatic and strong and big as what we saw in the US in particular, but also the UK and parts of Europe. So as a result, you're saying there are more job losses, there are more businesses that have gone bust. There's more economic scarring, I think is the term we would use as economists. So, and that slows the recovery. Could I suggest to you and ask you about one other potential structural issue that's maybe slowing the recovery? Because if I quote, so Chinese Vice Premier He, speaking at Davos, made the following comment: the real estate is still a pillar for China's economy. This is back in February. It accounts for nearly 40% of bank lending, 50% of overall local government fiscal resources, and 60% of urban household assets. So in other words, if the housing market's not firing, it's very difficult to generate confidence for the consumer to go out and spend. Now, I know housing is reasonably broadly owned, not as broadly owned as it is in the West, and there's a whole segment of the population doesn't own a house. But clearly, those with money own houses, and housing doing well creates confidence. And it seems to me that in the last year or two, with the property developers going bust, there's been some real challenges in the housing sector. And I wonder, and this is the question I want to ask you: has the psychology towards housing broken? And is the market struggling to clear? Because if I look at clearance rates for housing, and we can put a chart, I'll put a chart up on the screen when we do the edit, but you know the chart I mean. The clearance rates have gone up in Jan, Feb, March. In other words, it's taking longer to clear this market, despite the fact you're starting to reopen the economy, or it is reopened, and people should be starting to get interested in housing because money's getting cheaper and credit's being supplied to the economy. So is that one of the problems here, that the psychology towards housing has changed, that sort of link is somewhat broken?
So I think I want to emphasize the nuance on talking about the real estate sector in China. Overall, I think it's generally agreed upon what you said is right? The real estate won't be the pillar anymore. It won't, simply. Yeah. So the policymakers have realized they need to put an end to for the Chinese economy to rely on real estate development. The developers,
but Chen, isn't that a key point? Sorry to interrupt, but isn't that a key point? If it's been such a significant part of the economy previously, and we've all seen the estimates that it's almost a third of GDP, direct or indirect effects. If it's not going to be a pillar going forwards, it's going to be very, very hard to get the economy moving at any great speed. Is that not the point here?
We would argue that real estate is not only a driver, it's also a trap, right? So in China, real estate sector is very much segmented. Each city would have their own policy, right? So at least starting from 2015, it's very hard for you to speculate in the market. Even if you are wealthy, you cannot earn huge returns by buying into second tier, third tier, and fourth tier cities, right? It's very hard for you, or the cost will be very high. So it's not like you have a booming market where people are placing speculative capital into the market to earn quick money. It's that scheme has ended, at least before 2015. Second thing is that in terms of financial innovation, China doesn't have the kind of a financial innovation that you would be able to take a second mortgage so that you can benefit from the rise of your housing estate easily. So that would help drive consumption directly, right? So that part is also not there. And third thing is that when we say it's a trap, it's because it's making it much harder for the college graduates to settle in areas where we need them most. So I think there's an incentive there, or the government wanted to at least alleviate the rapid growth of the rapid rise of the housing prices. So that's number three. And number four, there are demographics, right? The baby boomers have already given birth to the second generation, and the second generation many of them are getting married, and then their parents all have houses, or because I think that's also known that the housing ownership rate is fairly high, right? So it's actually gonna, there are already surplus housing if you just put all the housing estate and divide it by the overall population. So in terms of growth, on average, there's no, I don't think there are any room for growth. But in certain cities, right? When we say mega cities, so going back to my previous points, right? The Yangtze River Delta, the Pearl River Delta, if you believe that at this stage you have about 100 million people in each delta, if you believe that in the next 15 to 20 years, these delta could grow into a mega city having at least 200 million or even more inhabitants, not necessarily in manufacturing, but many in high-end manufacturing, service, and consumer-oriented jobs, then you would argue that shifting emphasis on making cities connecting easier with each other, building intra-city infrastructure, and leading to kind of a boom in the countryside pockets in these mega cities is still going to be where the real estate would benefit. So I think there's a structural problem for the real estate sector. There's a demographic challenge for the real estate sector. You cannot take the real estate as a whole or an average in China, but still in certain areas, real estate there's still huge room for growth. But on average, any housing estate in third tier or fourth tier cities, they are gonna you're gonna see more ghost towns. You're gonna see more waste out there.
Right.
So what we are arguing
isn't this a real issue? I mean, it's the idea that you need a return on capital. You need a return on capital to sustain long-term growth, which is the same thing as you need to be driving productivity growth across the economy as a whole. That's how you grow economies. You can't grow them by building stuff and not occupying it.
What I'm saying here is that if you look at the 100 plus major real estate developers in China, half of them will go bust or has already gone bust. The other half, the survivors, they're all shifting. They're all changing their priorities. Maybe we'll be lucky to have 10, 15% of them sticking to their own real estate development paths. Many are changing. Some are getting into how can we provide more services to existing real estate, right? How can we provide upgrades? How can we leverage on the government policy to ensure existing and future buildings to be more environmentally friendly? How do we add all these things? So the shift is already there. No one is betting on building more housing in the future. That's already done.
Yeah. But where does that leave the drive of the economy? Because basically, if you think about China, very big picture, I mean, it was an export story 20, 30 years ago that was the main driver of growth. Then it was an investment story. And then part of that was the housing story as well, building out housing as well as infrastructure and so on. And those have happened, as you've just said. Housing's now no longer. So it's got to turn towards consumption. But it seems to me the challenge is that you're turning towards consumption at a time when housing is already very expensive. So anyone wants to buy a house, it's a real push. It'll eat up a lot of their income. But secondly, of course, you've got the aging demographic. And you've got an aging demographic in an economy where there's not really much of a pension system. There's not much of a healthcare system that's public. So people need to save a lot of money to provide for their healthcare and their pension in their older age. So it's very difficult to drive a strong consumption move, is it not? Unless you're driving very strong productivity growth, which drives good real income growth. But it's hard to do that if you've overbuilt and you're not getting a return on investment. So I struggle to see how China's going to successfully tilt towards consumption beyond running down bank accounts as excess that's built up over the last couple of years. How's that going to work in an aging society, that switch to consumption?
Yeah, it's I think you're on point to argue that that shift is very hard to engineer. I would argue there are three major areas we need to pay attention to. Whether China will be successful is a different story, but still you've seen signs that things are moving into the right direction. I think you still need to give the government some credits in terms of healthcare reform and pension reform. Of course, the pension reform is a different thing because there's a lot of debate on to what extent we should delay retirement age so that we can save the pension system to make it a bit more robust. So the government is working on this. Second thing is that if you look at the housing stock, even though it's not growing, it's not collapsing, and the government wouldn't allow it to collapse anytime soon. So the housing stock at this stage would still, for average Chinese house owners, unless you put out a mortgage in the last 2-3 years, still you get a buffer where you can rely on your own housing in terms of selling it, or there are pilot schemes in China to I don't know exactly what the right word would be, but try to finance, you use your housing as a financing to provide you annuities for the future. So I think there are enough housing stock, as long as it's not collapsing, to provide a kind of buffer for the current batch of pensioners. And I think the younger generation, I think it's my generation is okay, because you have parents who have housing, and then you would benefit from that. It's really about the those who are, we call it post 90s and post 2000s, the very young generation, whether they will be better off in the future or not. I think that's a big question mark. But exciting thing about these generation is that they are more cosmopolitan than any generation before. So the Generation Zs are very much similar to their Western peers, in, not necessarily in their worldviews, but in terms of their attitude towards housing, attitude towards cars, their attitude towards consumption, and their attitude towards work-life balance. So they are very different beasts. And then you would argue that the fact that China is a market. So I want to use two examples, not necessarily on the housing market, but two examples to show that there are going to be China-led consumption innovation that would be even a leader worldwide. So if you look at EVs in China, right? So who produced best EV experiencing in the world? Definitely not Tesla. It's really
BYD
about
probably.
NIOs, BYDs. So they are what we are trying to do. The reason they could be a leader in providing the overall package, not the driving experience. Driving experience is going to be a small part of it. Autonomous driving is only going to be a small part of it. It's really about how do you embed playing, watching videos, making phone calls, make a second office space, and moving a touch point for e-commerce. How do you make all that into one? So we would argue that the EV industry stand out for the kind of a innovation in consumer-facing innovation, and that consumer-facing innovation benefit mostly the Generation Zs, because they are the most consumption-driven ones. They are not going to save anymore. They're going to use up all their salaries, and they may take up credit card debts and all the other things, similar to what Westerners have experienced a generation or two ago. So that's shifting, that's changing, and that's going to provide you something very different, because China not only have the generation, but also have the scale, right? Because when we talk about Generation Zs, we're not talking about a few million people. We're talking about 100 to 200 million people, and these people have their demands, have their craves, and as long as we could provide reputable how would you say that? You provide the kind of salary that's equivalent to a middle income country, you would say that we are actually going to be in a kind of a consumption growth sweet spot. But the challenge, of course, is that whether the economy could produce that many high earning or medium earning jobs. You don't want the economy to be falling back into relying on or providing jobs that are security guards, that are managers in a metro station, that are delivery boys. There are hundreds of thousands of meat robots in the world, right? So I think that's the kind of a thing we are saying. And then who would be able to provide all these new jobs? It's still going to be entrepreneurs. So last year, one of the things I've been doing in China is really talk to experts, entrepreneurs, economists, policymakers to say that it's really how do we bring back the kind of entrepreneur-friendly environment? Because that's the only way moving forward. Otherwise,
Yeah.
if you say, could state sector provide enough jobs? No, I don't think so. Could public sector, the civil servants provide enough jobs? We have more civil servants than we needed, right? It's really about the other. Yeah.
Yeah, and that's the way to get your productivity growth going. If you get the entrepreneurs army sort of marching forwards and building new businesses and so on.
Yeah.
So just as we go on.
Just one thing I just want to add. So it's not my point, but I've been persuaded by a leading economist a few months back. So if you look at the talent pool in China, the graduating class, not the retiring class of this year, so those who are 60s or over, average college, so the percentage of those who have college degrees is 1%, right? So those who are retiring this year, and then those who enter into the workforce, college degree owners, 50%. So that's something, still you would argue that, many of these colleges may not be as good as used to be. And China has been producing, manufacturing many college graduates, but having an economy where the younger generation, 50% of them are college graduates, still means something. So you need to believe in the medium term. But still, I think the economy needs to transform itself. Yeah.
Well, that's clearly a real positive that you're educating the workforce. There's no doubt about that. So just tell me, as we're sort of the clock's ticking and we're running out of time, very simply, any sense of how much more stimulus we might get out of Chinese policymakers this year? We've had 2 big months of total social financing credit in January and March. We've had a reserve requirement ratio cut, and we've had little bits and pieces of reform and liquidity as well. How much more do you think might come? Do you have a sense on that? Any sense on what we might see?
I would put less emphasis on this kind of direct stimulus. We know it's going to be wasteful. We know it's the kind of easy policy initiatives that the government would resort to if they cannot come up with something more creative. We know it's challenging. It's a major challenge for policymakers to come up with something new, because resorting to something that they used to get is always going to be safer. Coming up with something more riskier means that you have to shoulder more responsibility. But I think the pressure of the need to grow the economy would mean that there will be more interesting and more innovative policy making in the near future. So again, it's a bet on the future, but it's also a bet that so the key argument is that I don't this kind of the normal stimulus won't save Chinese economy. It's really about confidence, trust building, credibility, consistency in policy initiatives, not interfering in private business, creating an environment where entrepreneurs feel that they could invest for the future. So it's all these things that would make China better. So what I'm arguing here is that aside from certain industries where, because of the trade war, because of the technology war, China needs to invest in, the Chinese state needs to be very much involved, like chips and semiconductors and other things. Aside from a small sector of these particular industries, China, if we do see the government playing a less interfering or entering into a less interfering mode, if we do see that the local government are going back to the competing for business and competing to come up with incentives to bring business to invest in their counties, in their regions, then I think you still could be, there are still many reasons to be optimistic. But I think this is a big if, because past 3 years have changed a lot of things, right? And there are many other risks that's out of our control. But I think the past 3 months have shown that, people, we still tend to believe that, the pro-growth policies, or at least there are policymakers who believe in this and who are capable of, continue to push for that. Yeah.
Brilliant, Chen. Well, that's extremely kind and a very good note to leave it on, I think, with a degree of optimism in contrast to what we've heard in prior podcasts. So I really appreciate your time. Thank you for spending this time with us. If people want to hear, I know you've been speaking today in your own capacity, personal capacity, but if people want to hear more from you, is there some way they can do that via where you work or via a website or anything in particular?
Yeah, I think in a way, this is also like a first time for me to really speak out in 3 years, right? So the last 3 years were kind of painful for many people in China, because I think there's a common understanding that certain growth trajectories have been artificially stopped or adjusted. So we are still kind of in the phase of back to normal to be able to reach out. So I think I'm on LinkedIn. So I think LinkedIn is the best place to find me, because there are still not many in China. So the technology-wide, China now is very much further apart from the rest of the world, because in terms of how the social media and other things, you don't use that many things that are commonly used in the States. But I think having a podcast, being on your podcast is an interesting experience. And if you are really interested, drop me a note on LinkedIn. I know I'll be there.
And what should they search for on LinkedIn to find you? What's the best search
my
terms?
name, Chen Wu, or the Economist Global Business Review, or I think that will bring
Perfect.
that would.
Brilliant.
Yeah.
Thank you so much. Thank you for your time. I really appreciate it. Wish you all the very best.
I certainly enjoyed it. I would hope, we are not saying I'm 100% optimistic, but what I'm saying here is that there are still room for being optimistic in China, and we need to have a new and nuanced view on China's prospects. And then there are different mental frames to analyze China, and also we need to understand that China is a very different beast from the kind of a free market economies that we or Westerners used to. But doesn't mean that China cannot grow. What I try to do is that these are nuanced messages that I hope more people would be able to understand and discuss.
Yeah. Well, I appreciate it, and I'm sure the audience appreciate it as well. So thank you very much, Chen. I appreciate your time. It's been a pleasure speaking with you.
Thank you, Chris.